Thanks for joining this presentation on stock market math. If you've ever wondered what a stock price might do in the future and why, this is the video for you. I've had trouble keeping a stock, for example, long enough to make the most of its growth over time because I didn't understand how it could grow as a business over a decade. I've had to live through it the hard way, but you don't have to do that because you're going to have stock market math in your pocket. Don't forget to like the video and subscribe if you feel we have earned it. The general math concept we're trying to learn is how to roughly price and how to roughly understand a business and its cash flows. From startup, it has no earnings. It might have some or very few sales, but as it grows, it becomes more and more valuable. It grows earnings, it grows sales, and eventually it becomes a mature company with not a lot of growth, but a lot of future dividends. That pricing and run-up is what we want to grasp mentally so that we know if a company is growing, it's earning, what's it going to look like in 10, 20 years? And are we pricing that in or is it not priced in? By the end of the math, I'm hoping you have a better concept of how to price things roughly, because the mistake we're trying to avoid is paying too much. If we pay too much for something, it becomes a premium. A premium valuation means we don't make as much money as we're supposed to until the company grows into that valuation. The best thing to do is to pay a fair price according to something like PEG ratio by Peter Lynch. Whatever the fair price is, we want to pay that so that we're not overpaying, and as the company grows, we get to make money right away. If we buy it below the fair value, we actually make even more money. If I offered you $1 today or $1 a year from now, would you value them the same? Are they the same, $1 today or $1 way in the future? Well, of course not. They are not the same. $1 in the future has to be discounted. Discounting is when you reduce the future value by some amount, factoring different variables. It has to be worth a little less than $1 today, because $1 today you have it, you can use it, you can spend it, you can do whatever you want. But $1 in the future, well, you can do stuff with the dollar you have right now that you can't with the dollar in the future, so we discount it. The variables affecting the discount we apply for the future money, it's going to include a variety of factors, including interest rates, expectations of inflation, just the general time preference and hassle of not having the money today, and also any other form of risk, which could include credit or counterparty. It gets even trickier when you try to price 10 cash flows or $10 or $1 every year for 10 years. How do you do that? If you just take the dollar and you add them together, all 10 of them, well, it's $10. But because they're spread over time, we can't be willing to pay $10 for that amount of money because it's going to be spread out at different intervals of time. So we have to do something to price those future dollars in today's dollars. Because the dollars are spread over time, we have to discount them, which means we have to shrink them by a small percentage depending on whatever we're using as a discount, or maybe an interest rate with an inflation rate. Whatever it is, we haircut each cash flow in the future. And it's quite useful for valuing payments over time. I don't want to dig deep into the math, but in this example, I have some math showing what the payments would look like with a 7% discount. 7% is a very common discount rate. Historically, over 100 years, 7% is an average interest rate. So Wouldn't be surprised to see a lot of 7s. If you want to look in, you look at every single payment, you divide it by the 7% discount by however many number of years. Then if you add all those payments, although they're all $1 in the future for 10 years, when you discount it, it's not $10, it's actually less. In this case, it's about 6.99 in today's dollars. All these payments over a decade, when you factor them by discounting them, they add up to today's dollars, 6.99. Now that's all fine and dandy for non-growth cash flows or an annuity or a mature company, but what about a growth stock where the cash flows grow over time? For a growth company or a company that has growing revenue and earnings, it gets trickier because you're going to simultaneously grow out with an assumed growth rate the earnings and cash flows, and then also discount them back. So they're going to grow, but then also shrink. You got to do both simultaneously, and this is the harder way to do it, but it's the accurate or the most accurate way to factor in and discount the cash flows. The easier and simpler way to understand growing cash flows discounted back is to just factor out what the company might be worth in 10 years or in some number in the future. Let's say a company earns $1, but in 10 years, if we grow out the cash flows, it'll earn some bigger number. If we factor in the growth rate, we will get some number that we can value the company and then go backwards. We have to use some kind of annual growth rate. So let's say we have a fantastic small company, has a great product, and it's growing at a high rate. We're going to use 25%. Next, we grow out the cash flow every year by 1.25. We do that for 10 years, or we can do 1.25 to the 10th power, and then we get some kind of a multiplier in the future, 9.3. A company that grows at 25% every year has higher and higher earnings and sales. 25% means that in 10 years it doesn't earn $1, it earns $9.3. So to clarify, in this example, 25% growth over 10 years turns our $1 cash flow into $9.3 a whole decade later. That's insane, isn't it? 25% compounds to 9.3 from $1. It really is wild to estimate what the future potential of a company can be. I actually find it very unnatural, because if you told me a company would be almost 10 times bigger with only 25% growth, it's hard for me to make that connection until I see it laid out. 1.25 times 1.25 times 1.25. If you do that over and over again, that you actually get that figure. But to live through it, you're not going to notice it, because it's not that much in real life during a year. 20 to 25%, you're not going to notice it in any given year, but over 10 years it really adds up, and divided backwards, it's a lot of dough. 25%, but if you do that 10 years and you have a 10 times bigger company divided by 10 years, that's like 100% return if you do the math that way. Now it gets even more tricky, because although we might get the math right, which is hard to do, the market's going to be volatile, and it might be above a fair valuation or it might be below a fair valuation. But if you have no idea how to value a company, you're just going to panic out or pay too much. And that's the tricky part. You have to understand the value fundamentally, and then it'll be easier to understand what you're buying, or if you should even buy, or if they're overpricing the company today and you're paying too much for the potential over time. If an investor doesn't know how to discount, they might pay 2, 3, 10 years of premium, a premium valuation more than they should pay because they don't know how to do the math. And that's the mistake we're trying to avoid by learning this stuff. The math concept we covered for cash flows that don't grow, it's also called a perpetuity calculation. And if you have payments for infinity, so let's say not just 10 years, but infinity, like a mature company that doesn't grow, you're going to want to use perpetuity. And the way you calculate that is you take what it earns and you divide it by some percentage. It's also like using a PE, very common. A lot of companies that don't grow, they're just going to have some multiple, whatever the S&P is doing. It might be a little less, it might be the same. But if you just divide it by a certain interest rate, that's how you calculate a cash flows value in perpetuity or forever. The second major concept is for valuing growth stocks using PEG ratio. PE is price to earnings. Compare that to growth. That formula is super important, but you really have to understand discounting cash flows first. Once you understand discounting cash flows or the perpetuity function, then you want to learn PEG ratio. If a company is actually growing, that's fantastic. That's what you want to look for. If it's growing at 25%, then 25 PE is roughly a good deal. You can pay up to 2 times, but it's very risky over time. And if you read Peter Lynch, that's what he covers. Price to earnings to growth, if they match, that's a great, fantastic deal. Roughly, whatever the company grows is what you're going to earn. So even if you pay a little too much, you just have to wait longer. You may have to wait 2 or 3 years to fix that mistake. Super important, very useful. Find quality growth companies. Try to figure out what they're worth. Make sure they have sustainable advantages. That's what Peter Lynch talks about. And as you can see here in the chart, if you find a good company at a good valuation, that's a very good purchase, a very good buy. If it gets expensive, you don't really want to buy more. It doesn't necessarily mean sell, because remember, you're trying to hold these for 10 years or 20 years. And this is just how it's going to move over time. The next step, once we have the basics of doing the math, growing and discounting, is to get really good at valuation, understand what companies are trading for, and then we can start to see what companies are attractive and make investment decisions based on that. That's more of an art and less of a math, and it gets a little trickier and it starts to get outside of the realm of what we can explain right here. But if you're very interested in taking the learning further, you're going to want to look up stuff like valuation of companies, how different people do their own valuations, current valuations of the market, and a couple good books. Peter Lynch, anything by Peter Lynch, he covers the PEG ratio, the PE to growth ratio. Benjamin Graham has Intelligent Investor. Those are really good books to factor future growth. The whole goal is that you're trying to figure out what it should be worth any given year. And then once you know what it should be worth, you can then see if the market is mispricing it. And if it's too cheap, you can buy. If it's too expensive, you got to figure out why, and if it's a mistake to buy it there, or if they're just pricing in the forward growth. So you see how it can get more and more complicated. I really recommend these valuation books. Peter Lynch is quite easy to read and quite enjoyable, and that would be where I would point you to next. I hope you found this useful, and again, if you've made it this far, please reward us with a like and comment and share if you feel the need or desire to do so. Cheers.